So, you're thinking about getting into the real estate game. That's fantastic. Real estate is one of the best ways to build long-term wealth. When you start looking at multifamily properties, duplexes, triplexes, small apartment buildings, you're not just buying a home. You're buying an income-generating machine. Before you can start collecting those rent checks, there's a crucial first step. It's called the down payment. Think of it as your initial investment, your skin in the game. It's the portion of the purchase price you pay up front out of your own pocket. A down payment is more than just a big check. It's a signal to lenders, banks, credit unions. When you put down a significant amount, it reduces lender risk. They lend you the rest, the mortgage, to complete the purchase. Your down payment is your share of the deal. It shows discipline to save and commitment to the property. Now for the big question everyone asks, how much do I actually need to save? In Canada, the rules for down payments are quite specific, and they change depending on the type of property you're buying. For a single-family home that you plan to live in, you might get away with as little as 5% down. But when you step up to multifamily properties, the numbers start to look a little different. These properties are classified based on the number of units they contain, and whether or not you, the owner, will be living in one of them. This is a key distinction that dramatically impacts your down payment requirement. For a duplex, if you live in one unit, you can often still secure it with a minimum down payment of just 5%. Triplex, fourplex, that minimum typically jumps to 10%. Things change quite a bit if you are buying purely as an investment, meaning you have no intention of living there. For any property with 1 to 4 units that you do not plan to live in, you should expect to put down a minimum of 20%. A 20% down payment on an $800,000 property is $160,000. That's a lot of money. But don't let the numbers scare you away. With a solid plan and some financial discipline, saving for your down payment is absolutely achievable. The first and most important step is to create a detailed budget. You need to know exactly where every single dollar is going each month. Track your income. Track small daily expenses. Morning coffee, track recurring costs. Monthly subscriptions. This will reveal where you can cut back and redirect that cash toward your savings goal. Once you have a budget, the next step is to automate your savings. This is a game changer. Set up an automatic transfer from your checking account to a separate, high-interest savings account. Don't just save what's left over at the end of the month. Pay yourself first. Consider looking for ways to boost your income, even temporarily. Picking up extra shifts. Starting a side hustle based on a skill you have. Every extra dollar you earn can be put directly into your down payment fund. In Canada, the RRSP Home Buyers Plan is a powerful tool. The size of your down payment does more than just get your foot in the door. It sets off a chain reaction that affects your entire investment. Think of it as a domino effect. The first domino is your down payment, and it directly knocks over the next one, your mortgage terms. A larger down payment means you're borrowing less money from the bank. Lower loan amount seen as a lower risk borrower, secure a better interest rate. Over the 25-year life of a mortgage, even a small reduction in your interest rate can save you tens of thousands of dollars. Mortgage loan insurance, often called CMHC insurance. In Canada, if your down payment is less than 20% of the purchase price, you are legally required to pay for this insurance. By making a down payment of 20% or more, you completely avoid this extra cost. Now let's talk about the fun part, your return on investment, or ROI. The size of your down payment has a direct impact on your monthly cash flow. Let's use a simple example. Say you buy a duplex for $600,000. If you put down 10%, which is $60,000, if you put down 20% or $120,000, that lower mortgage means a significantly lower monthly payment. It's a balancing act. When you're starting out, it's natural to compare buying a single-family home to buying a multifamily property. For a primary residence, a single-family home might seem simpler. The down payment can be as low as 5%. However, you are responsible for 100% of the mortgage payment every month. With a multifamily property, especially an owner-occupied one, you're getting a huge advantage. A tenant who helps you pay down your mortgage. My advice for new investors is always to start with an owner-occupied multifamily property if you can. It's the ultimate real estate house hack. You get to live in one unit while the rent from the other unit or units covers a significant portion, if not all, of your mortgage payment. This drastically reduces your personal living expenses and allows you to build equity much faster. It's like having your cake and eating it too. You get a place to live and an investment that generates income from day one. Before you start looking at properties, the very first thing you should do is get a mortgage pre-approval. This is non-negotiable. A pre-approval tells you exactly how much you can afford and gives you a huge advantage in a competitive market. Finally, remember that your first property doesn't have to be your forever property. The goal is to get in the game. Start small, learn the ropes, and build your portfolio over time. The experience you gain will become the foundation for your next purchase. You can do this.